You've got a new ETF out, relatively new, and basically it's sort of defensive and it plays inflation. Can you sort of walk us through the timing of this in terms of, how this illustrates what your market forecast is?
Yeah, well, just listening to the guys and you, I have to say I'm uncharacteristically cautious on the markets now because I think the Fed is very far behind the curve. Probably has at least 6 or 7 more tightenings, perhaps until something breaks. And so we have a SAMT, Strategas Macro Thematic Opportunities Fund, which plays both higher inflation and also gets somewhat more defensive in terms of cyclical defensive companies that have strong correlations with staples but aren't quite staples. And then we also have companies that play quantitative tightening, higher inflation. The one theme that's not working out quite as well is a return to travel and leisure, travel and entertainment stocks by businesses. But that is the theme. Those are the themes that make up that ETF.
Just curious, Jason, how do you think about some of these inflationary pressures that we're seeing on various commodities and input costs if the Russia-Ukraine conflict ends? Does that go away for the most part, or do you think that sanctions remain on and this inflationary pressure remains?
I think commodity price inflation is only one part of it, Melissa. I think you have rents, which generally tend to follow home prices. Home prices are up about 18% last year. You have wages. You're close to full employment. You have 11 million job openings. There's a lot of job openings, especially in the service sector. That's going to continue to put pressure on wages. And then you have environmental policies, and we could debate their usefulness or efficacy or wisdom, but they are going to keep energy prices higher longer than people think, in my opinion. So I don't, even if Russia were to mercifully, if Lord willing, our prayers were answered and the Ukraine situation was resolved peacefully tomorrow, I think there is an enormous amount of the policy mix that you've had, enormous amount of fiscal and monetary policy that still has to get worked off. So inflation, I think, is going to be with us for a long time. You can't really call it transitory if the Fed has to slam on the brakes to stop it. And the Fed had its opportunity to make a forecast on inflation last year. It was wrong. It doesn't have that ability politically this year.
Hey, Jason, it's Jeff Mills. Great to talk to you. I had a quick question. So you guys have some baskets that you track internally. I think they usually do a pretty good job of giving us an idea of either where the economy's going or something relative to policy. So you have your reopening basket and companies that would benefit from cyclicality reopening. That's sort of uncharacteristically levitated here as the 210 spread has really fallen off a cliff. So Talk to me a little bit how you see that basket's performance versus what we're seeing in the bond market.
Well, I think, the other, I would just say that is indicating, as you're pointing out, that the economy is going to be a bit slower. The one theme in the Strategas Macro Thematic Fund that isn't working is the return of business travel. There's another ETF that we have, which is Global Policy Opportunities Fund, SGAP, and that is focused on companies that do a lot of lobbying. That's doing a little bit better because it has somewhat more defensive companies in it. So I would argue that the economy right now, in my opinion, is showing some signs of strain, but I would not interpret that as a reason for the Fed to stop tightening. The Fed does not have a choice now. It is so far behind the curve that it has to continue almost regardless of what's happening in the geopolitical and macroeconomic environment. It really has to focus on its first mandate, which is price stability.